Hello, before we start today's video, just a quick note that if you are interested in purchasing this indicator, just simply email us at daytradinggps@gmail.com to request a discount promo code. In return for you taking your time for watching this video today, you can email us and request a discount promo code that will give you a substantial discount on the purchase of the indicator. All of our indicators are sold on a one payment for lifetime access basis. Thank you. Also, I want to point out that there are links to descriptions to additional videos on different topics that I will mention throughout this video today. And what I'm referring to is this section of the description of this particular video, where you'll find links to additional videos that go into more detail on different topics, which you'll see here. There is several different other topics which we have videos on that go into greater detail on those. We'll just touch on some of them during this video today, but if you want to see full videos on those topics, you can just simply look in the description of this video for these links. Thank you. Hello, in today's video we're going to be taking a look at the Monday, October 27, 2025 trading session for the CBOE SPX index, and we're going to be utilizing the SPX Daily Key Levels indicator from Day Trading GPS, and specifically the newest version of this indicator, which was just released a few weeks ago, the V2.0 version. Alright, so some of you may already be familiar with watching other videos on our channel regarding this indicator and already familiar with how it works. But for those that are new to this channel, I will run through how this indicator works. Please keep in mind, as I mentioned in the preview to this video, that there are other videos on other specific topics regarding how to use this indicator, and we're not going to go into great detail on those specific topics today. We may touch briefly on some of them, but to see full videos on other specific aspects of this indicator, please refer to those video links in the description for viewing those. Okay, so this indicator is for the TradingView platform. It does not work on any other trading platform, so you do need to have a TradingView account to use this indicator. This indicator works on two specific SPX symbols on TradingView, one of which is the one that you see on the chart now, which is the SPX CBOE index, and that is the main official index for SPX. So on TradingView, you'd simply type in SPX and then look for the SPX symbol that's under the CBOE exchange. You would utilize the indicator on this particular symbol if you're trading call or put options for the CBOE SPX index. This indicator does, however, work on a second SPX symbol, and we'll go to that chart now. And that symbol is the SPX 500 8 cap. Now on TradingView, you would go to SPX 500, you would type that in, and then look for the SPX 500 symbol under the 8 cap exchange. And this is a Forex CFD. You would utilize the indicator on this symbol if instead of trading SPX index options, you instead trade SPX using a Forex CFD via using a Forex broker. Another reason would be if you're involved in one of these Forex company challenges. There's lots of companies out there, probably 5 or 6 dozen, like FTMO, the 5%ers, Apex, and many others, that offer traders the ability to pay money to take a trading challenge that you have to make a certain amount of profit without losing a certain amount of money in a certain amount of time to prove your trading skills, and if you are able to pass the trading challenge, then you can qualify for a funded account with them. And usually in those situations that are companies that are involved in Forex, the symbols that you're allowed to trade on those are going to be typically Forex currency pairs like Euro USD or USD JPY, etc., or they will be index Forex CFDs like for the NASDAQ or the SPX, or they will be metals such as gold, or they will be crude oil, etc. So you could use the indicator for that purposes as far as trying to pass one of those trading challenges. Now, if you do trade SPX index options on the CBOE, there is one reason why you would perhaps want to have a second chart open on TradingView and have the indicator on this second symbol. And that is if you would like to see the daily updated key levels for the CBOE SPX index 30 minutes before it opens. If you're familiar with SPX CBOE, you'll know that it does not open until 9:30 a.m. Eastern New York time. It does not trade in the pre-market, and it does not trade in the overnight market. So the way TradingView PineScript works as far as coding of indicators is that if you have an indicator that is plotting levels, that even if your indicator knows what those levels are going to be, that for example, today, Monday, and if it knows what those levels are going to be before the CBOE SPX market opens at 9:30, it cannot display them on a chart that is on the SPX CBOE symbol until the first tick of the market open at 9:30, because that's when that specific symbol opens. However, since the SPX 500 8 cap is trading in the pre-market, then you are able to see the levels 30 minutes before the SPX CBOE opens and see them at 9 a.m. while on this particular symbol via this second chart here, which is for CBOE SPX. So these will be the same levels that will be on your CBOE SPX chart at 9:30 market open. This way at 9 o'clock, if you want to have the second chart open, you can see what those levels are going to be, and you can start looking at perhaps what type of strategy you might want to employ for today by getting a 30-minute jump on the session and getting those levels 30 minutes early. While on this SPX 500 chart, the levels that you actually see on the chart are for the SPX 500 as designated here by this line label, and by this chart here, which is also for the SPX 500. So the only thing as far as CBOE is going to be this second table here, which will give you those early, and they will give them to you at 9 a.m., which that's marked off here. So at 9 a.m. the market's open. If you have it on the second chart, this is what you'll see, and you will be able to get the levels 30 minutes early if you're trading CBOE SPX. Now we'll go back to the other chart. Okay, so now we're back on the CBOE SPX chart. As you can see, we're on a 2-minute time frame. That is the recommended time frame for using the particular strategy which we show in all of our videos for the SPX indicator. Although the range, the chart time frame range that you could use for this indicator for this particular strategy would be the 1-minute chart time frame up to the 5-minute chart time frame. We have found that the 2-minute works best. However, every trader is different. If you prefer to work off a 1-minute or a 2-minute, 3-minute, or 5-minute, the range is 1 minute to 5 minutes, although the recommended one for this particular strategy is the 2-minute. The indicator in general works in time frames of 1 minute up to 30 minutes. Now, for time frames of say 10 minutes, 15 minutes, and 30 minutes, those could be used more for if you were trading, say, the Forex CFD. You might be more inclined to utilize those levels because there you're not dealing with options. And another reason would be if you're using a different type of option strategy than the main strategy that we showed using with this indicator, which is simply buying calls on bullish entry signals and buying puts on bearish entry signals. There are many people that use this indicator for other types of strategies, such as selling options or doing iron condors, butterflies, or other types of combination option strategies that involve either the combination of both buying and selling options at the same time. They may be doing all sorts of different types of combination trades that are for different types of strategies, and for those types of strategies, typically a longer time frame, such as more tendency to the 5-minute, or 10-minute, 15-minute, or 30-minute is what most people are using for those particular types of strategies. However, the strategy that you will see us using on the videos on our channel for this particular indicator are simply buying calls on bullish entry signals or buying puts on bearish entry signals. Okay, so what about the levels in general? The most important level that the indicator will give you each morning is going to be the SPX Bull Bear KPL level, which for today was 68.4529. And what this means is that this is the all-important bull bear pivot for this session. So after analyzing recent price action in SPX, volatility, current market dynamics, as well as pre-market and overnight action in the ES E-mini futures, after analyzing many different aspects, the indicator will come up, as we told you earlier, at the earliest 9 a.m. While you have it on the other symbol, where you will get today's SPX CBOE bull bear key price level. So what this means is bullish above this level and bearish below this level as far as the session bias. And the bull bear KPL level is also the most prevalent level for taking trades in the opening moments of any session. So in the vast majority of sessions that you'll see, such as 95% or more, the bull bear key price level, whether it's on the 9:30 a.m. opening candle or in the opening moments of the session, that is going to be your most prevailing price level at which you will either be getting a bullish or bearish entry signal, either on the 9:30 a.m. opening candle or in the opening moments of the session. Now, as I mentioned earlier, we do have videos on other topics that are in the description underneath this video. One of those topics and other videos available for you to look at is, are there ever any instances where you would not take a trade off of the bull bear key price level at the 9:30 a.m. open? And in that particular video, which you'll find the link to in the description of this video, we go over how to recognize the few instances a year, and we're talking about maybe 2 to 5 instances where this might happen in a given year on average, where you would see how to recognize that you would not take a bullish or bearish trade off of the opening candle. The opening candle specifically meaning the 9:30 a.m. opening candle. Remember, there's about 250 or so trading sessions in an average year, and so we're talking about an instance where you'd have an aberration that might be happening 2, 3, 4 times a year out of those 250 times. But it is important to understand if you do see that type of session as explained in that video that's in the description, in that particular video on that topic, when to avoid the opening candle trade. Okay, so that's what that level is about. That's considered one of the main levels. The other main levels are the R levels and the S levels. The R1 through R6 and S1 through S6. Those are considered the other main levels of this indicator. So what do we mean by main levels? You can take bullish or bearish trades off of any of the main levels. Now, typically in the beginning of each session, the bull bear key price level is going to be your main level that you're going to be making a decision of whether to take a trade of a bullish trade or bearish trade off of that level. However, later on in the session, the other main levels will come into play, and you can also take either bullish or bearish trades off of those levels. And we have a video that is specifically on that topic, which is also in the description of this video, on how to take trades off of the other main R and S levels. And that is also another video if you wish to look specifically at that particular topic. And that particular video also goes into detail about the two different types of trade entries that you have with this indicator. One being your standard trade entry. It doesn't matter if it's a bullish or bearish trade entry. There's a standard trade entry, and there's also a conservative trade entry, which requires more confirmations. And that particular video will go over how to recognize the difference, how to tell the difference between the two, and it shows examples of both bullish and bearish examples of both the standard and the conservative trade entries. Okay, so the R levels above the bull bear key price level are your take profit levels for bullish trades that are taken off the bull bear key price level. Your main S levels below the bull bear key price level are your take profit levels for trades, for bearish trades that are taken off the bull bear KPL level. You also will see these midpoint levels and these QL levels. When you first turn on the indicator, the default look that's set that's hard coded for the indicator is going to be the R1 through R6 levels, the S1 through S6 levels, as well as the first midpoint above and first midpoint level below the bull bear KPL, and the QL level above and the QL level below the bull bear KPL. Now this indicator, you can turn on the QL levels above and below any main level, and you can also turn on the midpoint levels above and below each main level as well. The reason why only these midpoints and only these QL levels are turned on by default is because those are the most prevalent in play at the beginning of each session. However, you can customize this indicator to, instead, you can enable manually in the user control panel if you prefer different QL levels to be displayed or different midpoint levels to be displayed either in addition to these levels on startup or instead of these levels, just depending on which look on startup that you prefer to have at the beginning of your session for your purposes. So for example, this midpoint level here between R1 and R2, we turned on manually after it was evident that this was going to be a bullish bias session and the price was going to be perhaps traveling up to mid R1, R2, which it did happen to do later on in the session towards the end of the session. Now, what are the purposes of these midpoint levels and these QL levels? Well, the midpoint levels have a couple of different purposes. One is for continuing to gauge momentum in the direction. One of the other purposes that they have is for stop loss levels, depending on what level you're trading and also whether it's a bullish or bearish trade. And they act as what are known in this indicator as the standard stop loss levels. Whereas the QL levels are known as the tight stop loss levels, and whether it's a QL level above or below a particular level depends. It would be the tight stop loss on either a bullish or bearish trade, and we'll get around to explaining that further here in a few moments. Also, the midpoint levels can also serve as specific waypoints for target exits once your trade has gone or exceeded a certain amount of levels in your favor from the level that you started the trade from. So we'll also explain that later on in this video, how that works. So the main point I'm just trying to make is that the midpoint levels serve many different purposes, whereas the QL levels are simply the tight stop loss levels for bullish or bearish trades, depending on what level you're trading them from, and then also whether they are a bullish or bearish trade. Alright, so you'll also see these other levels here, the PMH, PML, YDH, YDC, and YDL levels. The PMH stands for the pre-market high. The PML is the pre-market low. YDH is yesterday's daily high, or specifically the previous trading session's RTH session high. So in the case of today is Monday, October 27th. So Friday was actually the previous trading session. And so this YDH level was Friday's RTH session high. The YDC level is the previous RTH session's close. So that would be the 4 p.m. closing price. YDL is the previous RTH session's low. So that would be the low of that session. Now these are important key levels as well. We will be coming out with another version of this indicator very soon that will also give you the stop loss levels for trading off of the PMH, PML, YDH, YDC, and YDL levels, should you decide that you prefer trading off of those levels, or you prefer trading those levels in addition to trading any of the other levels. Then part of the enhancements that we're going to have in the next version that's going to come out soon is that we're going to have bullish and bearish stop losses for those particular levels. Those will be specifically only standard stop losses for those particular levels, either a standard bearish stop loss for PMH if you had a bearish play, or a bullish standard stop loss for PMH, and the same thing for each one of these other levels. Okay. In general, those levels can also be considered significant levels that you need to pay attention to during the session, and they can also be used in a couple different contexts. So if these levels, depending on which direction that you're trading, are in the zone of, like we talked about earlier with trades, where it is close to or where it has exceeded the minimum required amount of move in your direction for a particular type of trade that we like to call the regular trade versus a scalp, then these levels here, whether it's the PMH, PML, YDC, YDH, and YDL, can also be used as additional target exits or decision points for exits or stop loss adjustments, because they are oftentimes places where you may see a reversal happen or you may see an explosive move happen because of the fact that they are important levels, such as the PMH. Obviously, in order for price to have a significant move to the upside, it's going to have to break through the PMH level and start closing above it. Same with the PML level. If we're going to have a significant move to the downside, the first thing it's going to need to do is start closing below the pre-market low and have successive candles below the pre-market low. And of course, on days like today where you have a significant gap day above, then of course the YDH and YDC levels could also be very important to be aware of, because on a lot of cases you will have on gap days where price wants to retrace and test where it was gapping from the previous day. And it likes to test those levels lots of times somewhere in the session. It may not do it right at the beginning of the session, but there are often times where it will go back and it will, whether it is a gap to the downside, and it will go back up and test the level, the previous session's level for where it was gapping down from, and vice versa like in today. Although we did not see that today, it will go down and test at some point in the session or come close to testing the previous day's levels from where it gapped up from. Also important to note if they happen to be close in confluence with other main levels. So here, even though we did not get any price action down in here today, you can see this is in confluence with the S2 level here, this YDH level, and the YDL level down here is with the S3 level, and then this YDC level just happens to be right about where the midpoint would be between this S2 and S3. Okay, and as you can see over here, there is a table for those particular levels as well. You do have the line labels here. Keep in mind that all these line labels are individually controlled by group, by what type of line label they are. So for example, the main lines, the R1 through R6 and the bull bear KPL, that's one group by itself. All the midpoint levels are a group by themselves, and all of the QL levels are a group by themselves. So what I mean by that specifically is that there is a setting in the user control panel where you can control both the size of that group of line labels as individually control that group's line label size, as well as the offset to the left or right for that group. So they're all individually controlled. As you can see here, we have, for example, the main levels turned on the large text size, the midpoints on the normal text size, the QL levels on the small text size, and the PMH and YDH, YDC, and YDL levels, those are all on the normal text size. These levels here, the YDH, YDC, YDL, PML, and PMH levels, also have their own group controls, as far as PMH and PML being one group, YDH, YDC, and YDL being a separate group, and you can control both the size and the offset on those as well. Offset meaning either moving them more to the left or more to the right. Also, these tables are individually controlled. You can move this table to a different section of the chart by itself. You can also turn it off if you don't wish to have it on the chart, and you can also control the size of the table. Same with this table, you can turn it off. If you wish to have it on your chart, you can change the size of it to be larger or smaller, and you can also decide where you'd like to place it on the chart as well if you wish to have it on the chart. Okay, keep in mind these comment boxes you see here are simply for following along with the video, and the indicator is not producing these comment boxes. These are simply ones that we have put in as far as making points at specific parts of the session and having the information about the cost of the various options that we're going to go through at when they were entered upon, and then also when they hit specific targets. Okay, so now let's get into the actual strategy. As I said earlier, this strategy is pretty simple. It doesn't involve combinations of options. We are simply buying call options on bullish entry signals, or we're buying put options on bearish entry signals. Alright, so to begin with, we have here the 9:30 a.m. opening candle. As you can see, we have a significant gap up from Friday's close. It may be hard for you to tell here because it looks like this candle opens up right on the bull bear key price level, but it actually opens up slightly above it. And as you can see, it travels above, so it opens and then starts going above. It has this wick here, and then it closes above the bull bear key price level as well. So this is the 9:30 a.m. opening candle, 2-minute chart. So this candle closes at 9:32 a.m. And the most important aspect of this 9:30 a.m. candle is where it closes. So this is a bullish entry signal, primarily because it closed. It's an opening candle and it's closing above the bull bear KPL. As I mentioned earlier, there are going to be a few instances a year where it could have closed above the bull bear KPL, but we tell you in that video the few instances where what to look out for, where you would want to avoid this particular trade even though it closed above the bull bear key price level, specifically on 9:30 a.m. opening candle trades. Same thing on below. If this candle had closed below the 9:30 a.m. opening candle, was closed instead below the bull bear KPL, and we were inclined to take a 9:30 a.m. opening candle trade, then it would instead be a bearish entry signal. And there are instances where, even though it closes below the bull bear KPL, the 9:30 a.m. opening candle, you would want to avoid a bearish trade on that 9:30 a.m. candle. It only happens a few times a year, but in that video that's in the description, we go through how to recognize when that happens, so you can avoid taking those trades, which those sort of occurrences, like I said, out of 250 trading sessions or so a year, only happen a few times a year. Now, as I said, the most important thing about this is where it closed. So it could have opened below the bull bear key price level, crossed above it, and closed above it. That's also a bullish entry signal. Conversely, this candle could have been like it was here, where it opened above it, traveled above it, yet then went back below it and closed below it. And that would be bearish. It also could have just opened below, stayed below, and closed below, which would also be bearish. So the main primary point is, where is it closing? for determining if you're going to take a 9:30 a.m. opening candle trade, where is it closing in relationship to this bull bear KPL level. In this case, it's closing above. That's a bullish entry signal. Now we just have to determine what call option we're going to use. And on any main level trade with this indicator, remember the main levels are the bull bear key price level, any of the main R levels, or many of the main S levels. On any main level trade, there are always 3 different strikes that you can use depending on whether it is a bullish or bearish strike. So there's going to be, on bullish trades, three bullish strikes you can consider using, and then depending on what level you're trading from. And on bearish entries, there's going to be 3 put strikes you could consider on bearish entries depending on what level you're trading. And the process of that is as follows. You take the level, the main level that you're trading from. In this case, that's the bull bear KPL. Your primary option play on an option trade on the bull bear KPL is going to be the at the money option strike closest to the bull bear KPL price level. In this case, that's 68.45, so that would be a 68.45 option strike. SPX trades in 5-point increments: 68.40, 68.45, 68.50, 6800, 67.95, etc., etc. So SPX trades in 5-point increments. So the closest strike is the 68.45 strike. This is the level we're trading from. It's a bullish entry signal if we're taking this trade, and it's the 68.45 call option is going to be your standard play on this bullish entry signal from this level. However, you have 2 other options that you can consider that are going to be out of the money options. And how you figure that out is, with this indicator, is what level are we trading from? In this case, this level. What direction? Bullish entry signal. So then you're going to look above the level that you're trading from to get the option strikes. How you determine which out of the money option strikes you can use, there's only going to be 2 of them. One is the first midpoint level above the level you're trading on the bullish trade. That's 68.5432. So in today's session, if you wanted to consider the first out of the money strike on this instead of the at the money, it would be the 68.55 call option. The furthest out of the money one you can consider is the 1 level away price here of R1, 68.6334. The closest strike to that is the 68.65 strike. So our 3 ones that we can consider is the standard option play, the at the money 68.45. The first out of the money, 68.55. The furthest out of the money, 1 level up, 68.65. If instead this was a bearish play and we were looking at puts, we'd look below. We'd still have an at the money of the same strike, 68.45, except to be a put. Then we would look below, the first midpoint level below, to get our out of the money put that we could use. In this case, since it's 68.3627, that would be the 68.35 put. The furthest out of the money put we could consider on this bearish trade off of this level would be 1 level away, the S1, 68.2724. The closest strike to that is 68.25, so that would be the furthest out of the money. Now we do have a video that will in the description of this video, which goes over how to determine the at the money and out of the money strikes on if you're going to take a bullish or bearish trade off of any of the other main levels, like R1 through R6 or S1 through S6, but it's pretty simple. It's basically the same process we just went over. If you were taking a bullish trade off of S1, the at the money is the closest to this S1 price. That would be 68.25 if the trade was derived from this level with the bullish entry signal. And if we were considering the out of money, we'd look at one level above, 68.3627. So it would be the 68.35 call option. And the final out of the money call option based on the bullish trade off of the S1 level would be the 68.45. If instead we were taking a bullish trade off of S2, the closest call option to this would be 68.10. We would turn on in our user control panel the midpoint between S1 and S2, whatever the closest strike is to that. Midpoint would be our first out of the money call option we could consider on a bullish trade from this. And if we were considering the furthest out of the money option, which one level above the S1, 68.2724 would be the 68.25. And if we were instead taking a bearish play, it would just be the reverse of that. Just looking down, turning on the midpoint here, that would be the first out of the money. This would be the at the money bearish put play. First out of the money, midpoint here. Furthest one, the one level below, would be this one. All right, so now what about stop losses? Stop losses, what is the level that we're trading from? The bull bear KPL. What type of trade? Bullish entry signal. For a bullish entry signal, if you want to use a tight stop loss, it's the first QL level below the level you're trading. In this case, QL below BBKPL. If instead you want to use the standard stop loss, what level are we trading? This level, bullish trade, first midpoint level below, mid BBKPLS1. So you're setting your initial stop loss by a level. Later on, if the trade starts going in your favor and you're doing a regular trade and not a scalp, which we'll get into in a second, regular trades have the stop loss adjustment option. Once it's reached its minimum target or any target exceeding that one thereafter, you have the option of, if you're not going to exit all of your positions 100%, you have the option of adjusting your stop loss at that time, which we'll go over here in a second. But at that point, you are then adjusting your stop loss by price, not by level. Only the initial stop loss is by level. Once you start getting into adjusting your stop losses based on the trade going in your favor, then you're adjusting it by price, such as break even. Break even would represent the price that you paid for the option. So in the case of this, if we were adjusting our stop loss to break even and we paid $14.20, then we would be adjusting our stop loss to $14.20, whereas to begin with it was based on a price level. One thing to keep in mind, if you're new to our videos and you haven't seen the other trading videos on this indicator, is that it's typically recommended to use the standard stop loss on any trade that you're doing and not the tight stop loss. There are many people that do prefer to use the tight stop loss. However, the tight stop losses are going to be more prone to getting stopped out. Some people don't mind that. If they just get stopped out, they'll just look for another trade entry, and they understand that this goes with the territory using a tighter stop loss, that they may have to get stopped out, and that they would prefer just to have less money at risk via a tight stop loss and take the chance of getting more prone of being stopped out. But that is completely up to each individual trader to decide on their own. We primarily use the standard stop loss. We find that on our trades we're primarily going for regular trades as opposed to scalps. There are people that use this indicator primarily just for scalping. However, we prefer to use a standard stop loss, and in most cases the standard stop loss is going to work out much better. I mean, there are sessions where both are going to get stopped out. That does happen. So don't get the idea that you never get stopped out with this indicator. That is not the case at all. If you've seen our other videos, there are plenty of sessions where we've done where the tight stop loss is getting stopped out, or both the tight stop loss and the standard stop loss are getting stopped out on trades. So, but the tighter stop loss is getting stopped out more often. Now, there are many cases where there's no stop loss, there's no stop out, such as in the case today. There are many sessions where neither one gets stopped out. So, but on the occasions where we are getting stopped out, the standard one is getting stopped out a lot less than the tight one. All right. So here we have the 68.45 at the money call option, and the price on the close of this candle is $14.20 for this at the money 0DTE call option. What that means, if you're not familiar with how options work, is you take the price you're paying for the option, you multiply it times 100. That's the cost of one call option. So if the call option, let's say, was $10 instead of $14.20, you multiply $10 times 100. That's $1,000. So it's going to cost you $1,000 per call option. You just want to buy one, it's $1,000. You want to buy 5, it's $5,000. You want to buy 10, it's $10,000. In this case, it's $14.20. So one is going to cost $1,420. Now that's the 0DTE one. That's the one, since today is Monday, October 27th. That means that the 0DTE is the 10/27 expiration date, and it expires at 4 p.m. today, 10/27. However, the 1DTE option would expire tomorrow, 10/28, Tuesday, 10/28, and that would be expiring tomorrow, 10/28, at 4 p.m. So that is why it costs more, even though it's the same strike price. Now, we don't recommend that you use anything above 1DTE on this indicator. The reason being is that, remember, with this indicator, you are opening and closing your positions in the same session, regardless of whether you're using 0DTE or 1DTE. So paying more for time premium above the 1DTE is not going to be beneficial to you, because you're not holding positions overnight or day to day with this indicator. You are opening positions. Sometimes you're closing them just minutes after opening them. It could be 5 minutes, it could be 10 minutes, 15 minutes, 30 minutes, an hour, or 2 hours, or it could be a couple of hours. But you are not holding on to any positions overnight or on a day-to-day basis. You are day trading these options. So because of that, you want to use only 0DTE options, or if you prefer, 1DTE. And in today's session, we saw a very good session for comparing the two because of the way this session went. Why? Because this session had a very narrow range for the vast majority of this session. This is typically not what you'll see in most sessions, where it has a very narrow range, meaning it doesn't even get to R1 or an S1. It's not even going to a level 1 outside of the bull bear KPL until almost 3 o'clock. So almost the end of the session, and the real move didn't happen as far as the move up to where we would normally get the regular trade to be exited, the 1.5 level move, until almost the last 15 minutes of the session here. So this is a good session to look at the differences between 0DTE, using 0DTE and 1DTE, and the pros and cons of each. Alright, so as you can see, the 1DTE option is significantly more expensive. It's about 50% more expensive. It's $21 versus $14.20. Now, one thing to keep in mind, that whether you're using an at-the-money option or an out-of-the-money option, you're still using the same initial stop loss regardless of whether you're using at-the-money or out-of-the-money, because the main relationship for the stop loss is just what level you're trading from, not what the strike is. So just keep that in mind. Okay. Now the out-of-the-money strike, 68.55. As you remember, that was the first out-of-the-money strike we could consider because we're taking a bullish trade off of this level. So as you can see here, the 68.55 on the close of this candle was $8.30. That's significantly discounted to this one here, the at-the-money. So you do have a lot less money you're laying out for it. But just keep in mind that the out-of-the-money strikes are going to have to travel further to make the same amount of money as the at-the-money strikes. And also, in a day like today, also keep in mind that the 0DTE options, if you're not getting much movement, the time value, any time value on those options starts greatly evaporating once we get past lunch, and then they start evaporating a lot, any time premium that may be left in them, as you approach the end of the day, because they expire at the end of the session. So for example, if you bought this option here, the 68.45, and you didn't set a target exit and you didn't set a stop loss, and at the end of the session at 68.45, well, that option's not going to be worth anything at 4 p.m. because the strike price is 68.45. Versus the 1DTE is still going to have time value because it doesn't expire until 4 p.m. tomorrow. So the point I'm trying to make is that you have to be caught, and we're going to get to this here near the end of the video, that you always, if you're trading 0DTE, and in most sessions that you've seen on this particular channel, most of the time you're getting a lot of activity in the first couple of hours of the session where you're either getting stopped out, and then your decision is, do I keep trading the rest of the day, or do I take trades off of other main R&S levels, or you're getting your take profit and it's reaching the target levels early on in the session, because most sessions are going to see price usually go to at least a 1.5 level move away from the bull bear KPL to a 2 level, 2.5 level, or 3 level move. So in this case, we had a very narrow range where it was barely even eking out of the midpoint levels here. So you're not going to see sessions like this that often, but they do happen. And when they do happen, you definitely have to be cognizant of the fact that if you're, especially if you're trading 0DTE, that is, if you're not getting any movement, as time keeps rolling on, at some point you're going to have to make a decision to just get out of the trade if it's not getting anywhere near your stop loss or your take profit, and it's just meandering along sideways and really going nowhere if you have the 1DTE that's just something that you have to, excuse me, if you have the 0DTE, that's something you have to be a lot more cognizant of because they will expire at 4 p.m. Okay, so moving along here, so that was 8:30 for the 0DTE, 68.55 out of the money call. However, the 68.55 1DTE call was $14.42. So again, the significant difference in this case, about a $600 difference. Now, what about the furthest out of the money strike? Remember, that was this up here because it was one level away. That's the furthest out of the money we can consider, one level away in the direction that we're trading from the level we're trading. 68.65 0DTE call on the close of this candle was just $4.10. However, the 1DTE call on this close was $10.11. So again, about a $600 difference. Up here, we had about a $680 difference. So keep in mind that, as we talked about, just to reiterate this one more time, the stop loss is the same regardless of which one of these strikes you're using, because the stop loss is based on what level we're trading from, not whether we're using an at the money or out of the money strike. All right, so as we see here, this was kind of a very boring session. We had this huge gap up from Friday, but we had a tight range, very boring session for most of the session. And we were just kind of meandering along, but eventually here in the 2:42 p.m. candle, we finally get a hit on R1. So now we're going to get into, some of you are already familiar with our scalping trades versus regular trades and how we define the difference between the two, but we're going to go over that again in this particular session. So a scalping trade, and when you're using this indicator, typically before you place a trade, you want to have an idea whether this is going to be, whether your objective with this trade is going to be a scalping trade with a scalping exit, or are you going to be doing a regular trade? Now you can also decide this in general. Do you want to use this indicator primarily for scalping, predominantly or always for scalping, or do you want to do always regular trades? Now you can do both. You can mix and match them depending on how you feel the market is for, or how it's looking on a particular trade at a particular time. You don't have to just do all one way, all your trades one way or all your trades the other way. You can mix and match them, but it is a good idea to know, to at least have an idea when you're placing the trade, what your target exit is going to be, and that's going to depend on what type of, or at least what your minimum target exit is going to be, and that depends on the type of trade that you're doing. On a scalping trade is only a one level move for a target exit utilizing this indicator. And how is that one level move defined? It's defined as one level above the main level that you're trading on bullish trades. So on bullish trades, it's one level above the level that you're trading. On bearish trades, it's one full level below the level that you're trading on bearish trades. Whereas a regular trade has a minimum required target of 1.5 levels from the level that you're trading in the direction that you're trading. The ideal minimum target on regular trades is a 2-level move. However, the minimum required target on a regular trade is a 1.5 level move. The difference between the regular trade and another difference between the regular trade and a scalp is on scalps there's no stop loss adjustment when it hit your target. On a scalp, one level move, you are exiting 100% of your option contracts, regardless of how many that you are using. So whether you bought 3, 5, you bought just 1, you have 2, you have 20, or you have 50, if you're only scalping when it hits your one level target, then you are exiting the trade. You're not adjusting your stop loss at that point. So you're only looking for a one level move in your direction, a one level move defined as one level in the direction from the level that you traded from. So for example, if we traded a bearish scalp of R1, a bearish scalp, we'd be getting out on the bull bear KPL because that's one full level away. If we were trading a bullish scalp from an entry signal, bullish entry signal off of R1, then R2 becomes one level away on that bullish scalp trade. So on a bull bear KPL trade, a one level scalp on a bullish scalp from the bull bear KPL is R1, whereas a bearish scalp would be S1, and a bearish scalp starting at S1 would be S2. A bearish scalp trade initiated at S2 on a bearish signal from S2 would be getting out on S3 because that is a one level move from the level it started at. Alright, so on this 2:42 p.m. candle hit where it hits R1 and you're getting out on a scalp if that's what your objective was, then here's how it works out on these different options. Now remember, this is at 2:42 p.m. Normally, a scalp, if you were scalping from an initial trade in a bull bear key price level, somewhere in the first 30 minutes, typically, you're going to be out of that trade one way or the other. Sometimes a lot earlier than that. It could be just moments later. So like I said, this is an unusual session just from the aspect of there was very little movement throughout the entire session, and most of the final explosive movement happened primarily like in the last 30 to 45 minutes of the session. So at this point, a lot of the time value is already out of these 0DTE options, as we will see here. So the 68.45 0DTE call price on this candle close of the 2:42 p.m. candle is $17.89. So that's a $369 profit per option. The 68.45 1DTE call, however, is $26.10. Remember, we paid $21 for that one, so that's a $510 profit per option. The 68.55 0DTE call on this candle close is $9. Remember, we paid $8.30, so that's only a $70 profit per option. Now that's because this is 2:42 p.m. If this was happening way back here, we would have a nice profit on this, but as we stated, a lot of the time value has come out, and so that you would have had back here had it done something back here and gotten to that up here during that part of the session. So now there's only a $70 profit on this 0DTE because it's so late in the session. The 68.55 1DTE, however, is $18.47. And we paid $14.42, so it's a $405 profit per option. The 68.65, the furthest out of the money, remember that was only $4.10 to begin with. However, since it's so late in the session, there's actually a loss now on this option, even though it hits the R1 one level move. And that is because it's happening so late in the session. At this point, at 2:42, there's only 1 hour and 18 minutes left to expiration on the 0DTE calls versus the 1DTEs, which don't expire until 4 p.m. tomorrow. So on the 68.65 call, you've actually lost money when it hit here. And you have a $188 loss per option. Even though it hit the one level target, it's because it's hitting it with so little time left in the session. However, the 68.65 1DTE call on the candle close is 12.40, and it's $229 profit per option. We paid $10.11. Now, later on in the session at 3:48 p.m., remember this is only 12 minutes to go in the session here, but we got a move up here. And it hits right here on this candle here, mid R1, R2. The regular trade, a 1.5 level required minimum move target for a regular trade, whereas the R2 would be the ideal minimum move, being a 2-level move. It's 1.5 levels. Remember, the scalp is 1 level, so one midpoint above is 1.5 levels from where the trade started from, the bullish trade from this level. Now, as I've noted here, normally, if this was happening much earlier in the session, you would have the option of doing an adjustment if you were so inclined to do a stop loss level adjustment here. You would have that option. You do not have that option because it is too late in the session. So your only option is to 100% closeout, and that is regardless of whether it is the 0DTE or the 1DTE. There is simply not enough time left in the session because there's only 12 minutes left in the session. So when it hits this target here, your only option, because it's so late in the session that this is occurring for the first time, meaning the 1.5 level hit is occurring for the first time now. Normally it would be happening a lot earlier in the session. Is your only option is to 100% close out if you were even still in this trade. Now, reasons why you might not already be still in this trade is because, frankly, it's taking so long here that we're getting past lunch and we still really haven't gone anywhere. So that's something for every trader to make up their mind if they're trading 0DTE and it's now been 3 or 4 hours and we're not really getting anywhere. We haven't been stopped out and we haven't really come close except maybe right here and right here. We haven't really been able to do anything to get a touch of this level. So at some point, even if you're taking a loss, you need to decide for yourself if it's worth even holding on to this position for the rest of the session. Because as I stated earlier, with the 0DTE option especially, if you, let's say, had one of these from earlier in the session, if it ends up closing at or very close to the price of the strike price that you got on your 0DTE, and it's 4 p.m., they're going to be worth nothing. So at some point, every trader has to make up their mind that if it's been several hours since the morning and it's still not really going anywhere, then you're better off just closing out the trade, taking a moderate loss, and looking forward to tomorrow's session or whenever this is the next session that you're going to be trading. Now, this happened to work out today. That doesn't mean that there could be another session where it just simply just meanders along and then does nothing the entire session. We do have sessions like that every now and then. They happen maybe once a month, perhaps twice a month. At most, you might see a session where the entire session doesn't even end up like it was today, where it just meanders along and there's nothing. It doesn't break out in either direction. It doesn't go anywhere. It's just simply biding its time, moving sideways, and does nothing. So those types of sessions will occur, and that's not the majority of sessions, but they do occur. So the point is that at some point, if it's not moving, you have to make up your mind that you're better off just taking a moderate loss and looking forward to another trading day. Okay, so in this case, you have the 68.45 0DTE call on this candle close when it hits at 348 is 28.25. That's $1,405 profit per option on this 0DTE. It looks like I made a typo here on this one. This should actually say 1 DTE, so my apologies for that. The 68.45 1 DTE call price on the candle close is $34.39. Remember, we paid $21. That's $1,339 profit per option. The 68.55 0DTE is $18.31 on this candle close. So now it is at $1,001 profit per option. Remember, you paid $8.30. The 68.55 1 DTE call price on the candle close is $26.40. Now you paid $14.42. So that's $1,198 profit per option. The furthest out of the money, the 68.65s on candle close, $8.70. Remember, you paid $4.10. So they have a $460 profit per option. And the 68.65 1 DTEs are at $18.59. You paid $10.11. So that's $848 profit per option. So as you can see here, this is 348. It didn't make it to R2 on this particular day. However, it did make it to the 1.5 level minimum required move for a regular trade. It did make it to the scalp. However, in this case, the scalp would not have paid off with some of these very well with the out of the money, simply because it's happening too late in the day. And we saw even one had a loss because it's happening too late in the day, and it was the furthest out of the money. However, when the furthest out of the money did hit the 1.5 level regular trade, it did have a nice profit, which basically $410 cost, $460 profit. So that's that's a nice on a percentage basis for that. But you had to wait until it hit the regular trade target. Okay, so that's going to wrap up this part of the video. We're just going to take a quick look at the Thinkorswim charts real quick, which will be the end of this video. Before we look at those, I'll just reiterate a point I made early on in the preview of the video today, which is if you're interested in this indicator, we sell all of our indicators on a one payment for lifetime access basis. And in return for you taking your valuable time to watch this video today, you can email us at daytradinggps@gmail.com to request a discount promo code that will give you a significant discount off of the regular purchase price of this indicator when you purchase it at the link that's in the description of this video. Alright, so we'll pause the video and now we'll take a look at the Thinkorswim option charts. First, we're going to take a look at the at-the-money 0DTE 68.45. Here was the 930 close above the BBKPL, close 1420. Here was the late day R1 hit on the scalp, 1789. Here is the 348 mid R1 R2 regular trade 1.5 level move hit 28.25. Here is the 1DTE call 21 on the close of this entry candle at 9:30. 242 R1 scalp hit $26.10. 348 regular trade 1.5 level move hit 34.39. Now we'll take a look at the 68.55s. Okay, here's the first out of the monies, the 68.55 0DTE, 9:30 a.m. close above the BBKPL on that candle, $8.30. Here's where we had the R1 scalp hit very late in the day. As you can see here, just $9 because all the time value evaporation. Here's the 348 mid R1 R2 1.5 level regular trade move hit, $18.31. Now here is the 1DTE 68.55, $14.42 on the entry, $18.47 on the R1 scalp at $2.42. On the 3:48 p.m. 1.5 level minimum required regular trade move, $26.40. Finally, we'll look at the furthest out of the money 68.65s. Here is the furthest out of the money 68.65, starting off with the 0DTE on the 9:30 a.m. close above the BBKPL, $4.10. Here's the 242 R1 scalp hit. We had $188 loss because the close is only $2.22. However, on the regular trade 348 1.5 level move hit, it did go to $8.70. Okay, now we'll just go back to the other chart real quickly. Okay, so I hope you've enjoyed this video today. Like I said, we have links to the other SPX trading videos in our video description of this video that you can look at on different topics that I've touched on in this video, that you want go into a more detailed look at specific topics that were just lightly brushed on. Here you can look at that, and there's also some links to some other SPX trading videos as well. And there is also a link to in that video description about utilizing stop losses on Thinkorswim as far as a feature of placing a stop loss based on the underlying price, which we talked about. That is what you do at the initial stop loss, is it's going to be based on a price level. And in Thinkorswim and they have that feature on stop losses where you can base it on the price of the underlying instead of the price of the option as an additional feature that they have, feature enhancement. That feature is also found in another platform called Interactive Brokers. There may be other brokers that offer that as well. You just have to check with your own broker if you don't use either one of those. However, keep in mind that once you are in the, if your trade does move, if you're doing a regular trade, at least the 1.5 minimum move, at that point, you're no longer doing a stop loss by a level. At that point, you're just using the regular stop loss, which all brokers have, which is just going to be based on the price of the option of moving it to break even or better. Break even plus typically a 10 to 15% profit buffer, which we've gone over in more details in other videos where as the session played out, there was that option available. Today, that option was not available because the 1.5 level move happened so late in the day. Alright, so thank you again for taking your valuable time to watch this video. Please like and subscribe to our channel. Please like this video. It does help us with the YouTube algorithm, and we would appreciate your help with that if you did like the video. And we wish you much prosperity in all your future trading endeavors. Thank you.